Well, I think there are parallels. I found that question was interesting because some of the environmental risk as well as some of the financial risks prior to the crisis were hidden, but a lot of them were really obvious too. And the question was whether people wanted to look and deal with that. So when I first came to the FDIC in 2006, our economists were very worried about this. And we went out and bought databases of the mortgages that were in the securitization trust. And it wasn't hard to go out and buy those databases, and we couldn't believe what we saw. But I think now, whether it's shrinking polar ice caps or, the air quality in Beijing or whatever it is, I mean, there's a lot of, rising sea levels in the Chesapeake Bay watershed. There are a lot of kind of obvious things going on now. And the question is, do we want to see them and confront them head on, or do we want to pretend like they don't really matter? And I think there's a lot of pretending that the mortgages didn't matter prior to the crisis, and that is another parallel today with some of our environmental problems. Well, I think the potential scope is much greater and much more broadly felt. The economic fallout of the mortgage crisis was very heavily felt by working class families. So these subprime mortgages were heavily marketed to working middle and lower middle income neighborhoods, and you still see some of them that are devastated by the foreclosures and all of that. So the good news and the bad news of the environmental consequences is that's going to hit everybody, and it is hitting everybody. And so I do think that the magnitude is greater, the dispersion of the risk is greater, but it's more gradual, I think, and because of it's a steady erosion more than a sudden shock, the way we have the financial crisis, which in a way makes it more difficult to deal with because people keep thinking they have more time, they can kick the can down the road when we really can't. So that's very important, whether it's environmental issues, whether it's financial risk. I'm a big believer in market discipline. I think you need a role for regulation, but it needs to be complemented with market discipline. And you don't get good market discipline without good disclosures, consistent disclosures, so investors can compare. It's global. It's hard to assign ownership. Peer pressure is good too. So, having I'm on the board of Host Hotels. We're on your A-list, and we love that. And so, creating some peer pressure around that is good, and companies should advertise that and promote that and use that as a competitive edge in the marketplace. The energy savings we have achieved just by going green, and it's been hard for us because we have a lot of old buildings, and it's sometimes the upfront expenditures can be significant, but we feel better about it, but we're saving ourselves a ton of money. So I do think there is a lot of financial benefit to be drawn by just thinking about this and what you can do to reduce your carbon exposure. And the more the government, as part of their policies, can force companies to internalize the costs that they're creating, that will also create better financial incentives to go faster. And so, and I know there's a lot of uncertainty now about what the new administration's positions are going to be on these environmental issues, but that just makes it even more important for companies to take the leadership on their own, because it's, we all have kids, we all have families, we all have young people we know, and it's just, this is our planet, this is our country, and one would hope that kind of motivation would be powerful as well, in addition to dollars and cents.